We are live, Madam Chair.
All right, good afternoon, everyone. Excuse me. I'd like to call the meeting to order and acknowledge that we are in Treaty 1 territory, the home of and traditional lands of the Anishinaabe, Ojibwe, Innu, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Marla Billinghurst. I will be chairing the meeting this afternoon. On the panel with me are Mr. Harvey Diamond and Mr. Robert Hutchings. Representing the assessment department is Mr. Jeremy Paul, and the administrative personnel is Mr. Jaswinder Kumar. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony, followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all of the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You will receive the board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We will be hearing all items on the docket today. Mr. Kumar, please affirm the assessor's and the applicant's testimony.
Yes, Madam Chair. Thank you. So, Assessor, please state your full name.
Jeremy Ryan.
Thank you. Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Please. Mr. Neufeld, please state your full name.
Rocky Neufeld.
Thank you. Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. So, Mercury, please state your full name.
James Mercury.
Thank you. Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Okay, thank you very much. The first matter on the docket is 125 Gary Street. Mr. Paul, please proceed when you're ready.
May I make a suggestion, Madam Chair? We're dealing with a non-compliance matter for 240 Kennedy. Is it all right if we hear this first? I'm assuming this is why Mr. Mercury's involved.
Mr. Mercury, is that the only?
That is the primary matter I'm dealing with, but Mr. Neufeld did ask me to attend on behalf of the 125 Gary matter as well. So I leave it to the board to determine. I don't think we're have a preference one way or the other. I'll let maybe Mr. Neufeld speak to that, but if Mr. Pohl's preference is to proceed with the first issue, that's fine. The another property, that's fine as well.
And sorry, and there was one other matter. There was 414 Graham is on the docket for today, and I've had some conversations with the manager of appeals as to service notice, and I was I had the understanding that it was going to be rescheduled. Has the board been made aware of this or not?
No, I'll have to discuss that with the board.
Okay, because she suggested, which I filed an affidavit, which I did this morning, and I believe the clerk has that affidavit. And given the matter, given the issues around it, I think she said an adjournment should be in order. But and if we have to argue it, then Mr. Mercury will have to be around for that.
Argue for the adjournment or argue the matter?
Argue for the adjournment.
Oh, okay. Perhaps I will. We'll get to that one in a few minutes. But
Okay.
sorry, which was the one with the non-cooperation?
240.
40 Kennedy.
Okay, so I guess if Mr. Mercury, so essentially you're here on 125 Gary, 240 Kennedy, and possibly 414 Graham. Is that correct?
That's correct.
Okay, so perhaps we'll just start with 125 Gary and then we'll move to 240 Kennedy.
However the board wishes to proceed is fine.
Okay, and then at least deal with the ones that you're on first, so then you can leave, not sit through the whole thing. Okay, so let's start with 125 Gary Street, please.
Okay, I have no preliminary issues with 125 Gary. So is there any preliminary issues with 125 Gary from the Collins standpoint?
I don't believe so.
Okay. 125 Gary, roll number is 120931611600. Again, 125 Gary, the 2023 assessment is for $19,384,000. It is a Class B office building, 13 stories, built in 1970s era, mid-70s era. It has a leasable area that we know of 113,332 square feet approximately. There's 182 outdoor parking stalls. Parkade that's attached to it. If you look at the income stream on page 3, we have an overall rent of $13.50 applied to it. Our standard, which gives us our potential rent of $1,530,366 attached to the rent, the leasable areas I just noted. The vacancy for Class B is 11%. I looked at this in percent change review. There's a bit of elevated vacancy at the reference date and under market for a significant amount of time vacancy leading up to the reference date. So I made an adjustment up from our parameter of 11% vacancy to 13% to account for that. It's in relationship to the vacancy that's occurring on site and the overall long-term performance of the building. So from that, your effective gross income is $1,331,418 or $1,331,000 can't speak this morning for this afternoon, $418. Our expenses that are 3% non-recoverable. Our shortfall is at $12, which gives us a net operating income of $1,114,672. That's capped at 6.75%, gives us our capitalized value for the building at $16,514. On page 4 is the market value for the parking structure. It is outdoor, it's not indoor. It's a parkade attached to the building, and I'll get to the pictures of the building in a moment. We have a net rate of $92, which produces our net operating income of $200,920, capped at 7%, gives $202,870,400. On page 5 is the overall workup. Combined, our value is $19,384,000. So with that, that's what we have on file. I will go quickly through the pictures on page 8. It's located at 125 Gary. As you can see, it's a Class B building with outdoor parkade, rooftop parkade, parking, as well as multi-level parking. Our comparables are on page 13. They indicate $92 a square foot. For the median and mean for the parking. I have a bit of a different analysis. I'll get to that in a moment because there was a municipal board appeal on this for a earlier set of years, but I'll touch base on that. For now, we're recommending 92 million for $92 per stall. On the next page is our OFB market study. I did a market study, and I'll go through this today in a bit more detail. I did a market study of the Class A and Class B buildings, the inventory of every property that rented out on a net rent basis. And this was done to ensure that fair and equitable assessments of these property type classes. The studies were also being used for appeal purposes for a tribunal, so that we can get the appropriate assessments at the Board of Revision when we're at appeal. The documents that are sourced from 2 independent 6-year studies that reviewed every OFA and OFB property that leased out on a net basis. The studies encompassed 660 CRUs, over 4.4 million square feet of inventory was looked at, and that was over, again, six years leading up to the reference date. Each study examined individual properties, the global marketplace, and cross references outside sources in terms of advertised leasing activity. All parameters in studies are isolated to individual years and are in relationship to each other. The statistical analysis determined averages, weighted averages, medians, min-max ranges as well. The rent values were further examined using standardized bell curves with a standard deviation of 68%, 95%, and 99.7%. So those are your standard deviations for statistical analysis for 1 standard deviation, 2 standard deviations, and 3 standard deviations. And the result is that they produce near perfect normalized distribution patterns. So overall, the OFA and OFB marketplace studies are the most comprehensive examination done by their assessment taxation department on office property, and it ensures that these properties are correctly valued using a true fee simple basis. With that being said, I looked at every rent, I looked at every leasable building. This analysis was done completely by myself. And vetted through me. So this is new at this level of tribunal. It hasn't been done at the municipal board. It is a large undertaking, and you are the first, the panel and this cycle of appeal at Board of Revision is the first to see it. So with that being said, I'll get into the actual study starting on page 14. As you can see, the overall global marketplace is, as indicates, it rents out for approximately $14.39 a square foot. There's an average vacancy of about 12%, weighted vacancy of about 12%. Again, all 6 years are looked at individually, but the last 3 years, the 18, 19, and 20 year are stabilized. And the reason why I did that is because, quite frankly, if you're going to be buying and investing in a property like this, A and B class properties, they're investment vehicles. You should be looking at more than 1 year. You should be looking at enough of information pushing the reference date to get a true indicator of market. And what I've been doing at the municipal board is looking at the subject properties for 5 years, but only stabilizing the last 3. So that seems to be a very well-rounded way to look at it. So we've done every single property for both A's and B's, same way. So you can see that 217 leases were looked at, or CRUs were looked at that leased out. It's about 1 million square feet of inventory, and the shortfall indicates about $13.88, and the non-recoverables are at about 3%. Now, again, I'm not going to get into the big non-recoverable argument like we did last cycle. Everyone's well aware of it, I'm sure. Our non-recoverables do not take into TIs, tenant inducements, free rents, below line item expenses. We are developing a net operating income. We are not developing a net income to the owner. So the non-recoverables may differ because most tax agents have, they include some of those items that we don't. And typically, I'm not going to get through every municipal board order, but we have numerous board orders that say we don't. Given the entirety of the last cycle, I've yet to see an order from a tax agent from the municipal board that said we are looking at those office properties. We do include those to reduce the effective value of the property. So with that said, I'll move on to the chart below. The OFB rent, as I indicated, these are the 3 years that were graphed out. They are normalized distribution pattern. You see that's one standard deviation, which is the 144 CRUs. In your statistical analysis, you should be looking at your median market. This is 60% of the market. This is the vast majority of the marketplace fall between $12.79 and $15.99. Outside of that, you start getting to your outliers. Your second standard deviation, which ranged from $11.20 to $17.59, and then your third standard deviation, which is really, really extreme, which is farther than that. So the mean of the market is within approximately $13 to $16. So below that, bear with me here. We looked at outside sources. As indicated, we used the Johnson report and we used Cushman Wakefield. These are the two reports that I look at simply because they provide the same linear information from year to year to year. Other reports typically give pieces of it, but not the same reporting for every particular year. So it's a little bit harder to piece together. So in this case here, Cushman Wakefield indicated stabilized $15.57 rent, net rent for the 3 years advertised leading up to the reference date with a vacancy of approximately 10%. You look at the Johnson report, which gives more detail. This is from the Johnson report, which is the December version of the 2020. It's not post-reference. As we look at the actual information at the end of the 2020 year, they indicate a weighted average of $15.37 for your rent. They also indicate a vacancy of approximately 13%. And I'll put in the last line there, I've adjusted out the owner occupied spaces. What they actually report is 7%. I should say stabilize at 7%. The individual years are as what you see next to that. But I've extracted out the owner occupied property. You shouldn't be including them in a market study if they don't participate in the market. Johnson report does advertise the vacancy and whatnot on properties that are owner occupied. So rather than including them in, you shouldn't, because that would skew the number downwards. Obviously, if it doesn't participate in the market, if you include that in the vacancy, it inflates the actual occupied area, which you shouldn't do. So after that is the shortfall, which indicates that approximately $14.59 is the actual shortfall for the marketplace. So all this metrics that you see in front of you, this is coming straight from the INEs that were reported to the city. It's been reviewed by myself. Then I cross-referenced it to see what the property owners are asking outside of the tribunal process for what their spaces are offered at. On the next page, 15 and 16 are the actual individual studies on the properties. You'll note that virtually every property that rents on a net basis for an Ofb is in this. 125 Gary is not in this, as I've indicated, and I'll indicate a little bit now. This property was reviewed at the municipal board. Assessor's opinion, it was under market rents, and it was issued with the income streams that were there. There was below market vacancy. There was virtually no market vacancy. One rent was at $13, one was at $8. We had a long hearing on it.
Mr. Paul, we're not hearing about decisions from the municipal board, so please continue.
I need to present my information the way that I see fit. I'm just referencing it quickly. So if I'm allowed to speak to why it's not in the brief, that's why I'm highlighting it. So basically, we haven't got our order back from it indicating anything, so I've left that out. And again, there's only two major series. On the next page, starting on page 18 and on page 19, you see the actual data from the Johnson report. So this is the index for each year for the Ofb portion of it, and you can see if you go down, it's 1, 2, 3, 4, 5 down is the actual 125 Gary subject property. You see that they're reporting 115,650 square feet of leasable area, and there's 0% actual vacancy in the building in 2015. So if you go through the years, it follows the same up until about 2018, when they report 5.9% for vacancy. And then in 2019, they report 50% vacancy. And in 2020, 20 report 51.5% vacancy. So there was a little bit of a increase in vacancy as one of the major tenants left. So in following pages after that, some advertising of the property. It's consistently advertised and marketed at $14 a square foot net. And that's over the span of the next two pages. Ending in page 34. So you can see it's been advertised in the marketplace at $14. So as we can see, starting on page 35 is the actual income expense for the 2020 year. We see that there's an elevated level of vacancy within the building, which is adjusting the net operating income downwards. That's highlighted throughout the income stream. If you have the financial reporting, if you read through it on page 37. Then you look at page 38, it's where they're actually getting into the rents. The building, which you can see at $14 for one of them, highlighted in yellow on page 38 for Wall East Mutual. And then highlighted again on page 39 for Stephen Rosenfield at $9. And you can see that the rent escalates to $14. Same thing where you can see for First Nations Financial, $9.15 escalates to $14.50. And then if you look on page 41, you can see that the property is being, for the parking anyways, is at $180 gross a stall. And there was numerous reports of $180 for one stall, and then there's other numbers there that indicate that they're at least up for more than one stall. So at $180 appears to be what the stall gross rate is. Afterwards, we can go to my page 49. This is a quick synopsis of the information from the municipal board where we dealt with. It gives a study back to 2008, which indicates that there was some discrepancies in the rents between $13 and $8 range. We also see that there was a much below market vacancy within the building. You look at page 51, or starting at page 51, is a municipal order from 330 St. Mary's. This ties into vacancy. One of the points was vacancy. Highlighted.
I cannot hear Mr. Paul anymore. Hello? Hello? Can anyone actually hear me?
I can hear you. I can't hear Mr. Pohl either.
I can hear you, but not the board.
Boardroom. Okay. So it's not just me. All right. This is great. Mr. Kumar? Hello? If anyone is able to hear the boardroom, just let me know, because I still cannot. I'm going to try to email them. Maybe they will.
Harvey's waving, but that's it.
We're working on it.
There we go.
Oh, there. Okay. Okay. We can hear you now. Good.
So where did we cut out at? I don't know.
They can hear us now, just when they're,
Yes.
So where did you guys cut out? We don't exactly know.
I'm sorry. I don't know what happened.
Page 51.
Page 51. Okay, so getting back to the 330 St. Mary's order, which is a recent order, basically skipping ahead to 59, one of the points was vacancy. The property was experiencing a higher rate of vacancy at the time of the reference associated with market vacancy. There was also indicating that the surface rate for parking was a little greater than what was put on the property then. Same marketplaces now for NC 161. I'm not exploring a higher rent for surface parking at the moment because I haven't done the analysis to change it from what the model produced. So the $92 is fine for stall. I'm not asking for an increase on that. If you look at the vacancy on page 62, you can see actually 330 St. Mary's was at 5%, and then jumped to approximately 24.7 or 25%. And that was taken into account by the agent. When we look to the actual order, which indicates on page 69, highlighted in yellow, the agent calculates the vacancy at 11.78%, inclusive of the larger vacancy because one anchor tenant left the building at that point in time. The methodology overestimates the vacancy at a single point in time rather than estimating the stabilized vacancy rate for the property of this quality. At the post-reference date, post-reference vacancy rates included in the agent's briefs were not considered by the board. The board considers the assessor's analysis to be more reflective of the market and will apply a market vacancy. So that's what I've done here today. I've looked at the actual property and went, what's the actual marketplace? I brought you the marketplace. What's the actual performance of the property? You can see that it's near zero vacancy for a substantial amount of time, and then one of their anchor tenants left. Market vacancy was at about 11%. I made an allowance for the 1 year, 1.5 years, about 2% on top of that to 13%. I feel that's reasonable, and that's in the relationship to the marketplace. So then there was some issue whether this was a Class A or Class B building. On page 73, the board has already ruled that it is a Class B building. I just simply highlighting it that it is a Class B building. And to further back up our position on cap rates is on page 78. I reviewed all the properties that have sold for Class B buildings leading up to, not quite this reference date, but these are the last buildings that have sold on a Class B building with income streams. You can see on 240 Grand, the cap rates are associated at about 6.1% to 6.7%, depending on the year that you look. The stabilized view is 6.31%. On page 79 for 220 Portage, again, approximately 6%. If you look at 330 St. Mary's, stabilized, reconciled. If you look, there was a sale involving, and that where they only have partial information for the year for reporting. But reconciled, it was at about 7.17%. And you look at 175 Hargrave, it was at approximately 6.84%. So overall, the range appears to be for that point in time between 6 and 7%. With the way that industry, where that industry was, and the way that the consistently investment Bank Canada rates were lower and consistently low, you would expect that these be reflective, or maybe even a little bit less than that, approaching our reference state. So. And then back in the last 2 or 3 pages is simply the board synopsis that we do not include any form of tenant inducements or improvements for leasing commissions or free rent. I'm not going to go through all of them, there's multiple orders, but they're there for your reference in ADB. So when we look at this property at 125 Gary sitting today, 19,384,000 seems very reasonable. It seems right where average view would be a bit below the marketplace at 1439. You see that the vacancy, yes, there's a bit of an elevated vacancy due to one anchor tenant leaving. 330 St. Mary's order already indicates that we don't look at that as far as there's no obsolescence to the market, there's no barrier to market. So market rent and market vacancy should apply, and that's what they did in that case. So that's what I've done here too. With the exception, I've given it a small 2% increase on top of the 11% because I feel it's warranted. It's an average B. It's not a below average B. It's not a prime B. It's just an average B.
Yes, we understand what you said.
So
Proceed.
on that relation, I feel the assessment is fair, and that 19,384,000 should be applied or confirmed here today.
Thank you very much. Mr. Neufeld, Mr. Mercury, do you have questions for the assessor?
Yes, we do. Regarding Sorry, I just got my screen to coincide with the assessment brief. Okay. Starting with page 3, with the exception of the vacancy rate you reported, is the rest of the values been generated by the model?
Yes, correct.
And page 4, is this all been generated by the model?
Correct.
Okay. And you note on pages 3, 4, and 5 that there are different cap rates applied to different revenue streams. How many titles are in on this roll?
I believe there's one.
So they can't split the parkade structure and sell it, can they?
Not unless there's an adjustment made to the titles.
Okay. On page and you adjusted it, sorry, you adjusted this to 13%, which is roughly how much in terms of square feet?
I didn't do that calculation. I just did it on a percentage basis.
Okay, so I'm gonna just put it to you that it's approximately 113,331, 14%. I get that? No.
That's what the number works out to be. I didn't do it on a per square foot basis.
Okay. Sorry, 11.5%. Seems about right. No, I know I'm going to get this wrong here. 13%. I know what I did wrong. 0.13 times 113,331. That's approximately 14,700 square feet.
I'm not sure which number you're starting from. The reported 113,332 square feet of leasable area that was reviewed in the past at the municipal board and leading up to the date today, or is it the 123,177 square feet that you have listed in your brief, and that's on the actual current INE? So
Well, we only ask questions about your evidence, not my evidence. So on your page 3, you have 113,331 square feet, 13%. Just roughly, is it fair to say that the math on that would indicate about 14,700 square feet of vacancy on a per square foot, on a square foot?
I'll trust your basis if you're using the calculator. I don't want it.
Okay. Now on pages starting, I guess, on page 20 and going all the way to page 25, what was the date of this report?
It would have been, what do you mean, the listings? They're not a report, just the advertised listings?
Well, whatever you would call this. Is this is one continuous report, pages 20 to 25? Is that correct?
Yeah.
And when was it published?
This would have been before 2018, late 2018. You can see the advertised availability is 2019. So again, this has been advertised at $14 for some time leading up to the reference date.
Okay. And did you have a chance to add up the square footage that was available?
Just looking at the listings for the offering of what they're leased out at, or offered to lease.
Well, I'm just adding it now, and I just want this on the record. And I'm looking at page 25.
57,144 square feet is being offered, and at a lease rate of $14 net. At the top of the page, left side.
Page, yes, I thought it was somewhere there. I just added up. So 50.
When those exact availability dates are, that's not quite, they have a little bit of that advertising. That's all depending on the appropriation.
Sorry, and what page was that 54,000 on?
57,144, that's on page 20, top left. Right under heading 125 Gary,
Right.
about 6 lines.
Okay, yes, thank you, thank you. So in 2018, they now have 57,000 square feet available. And as of April 1st, 2021, are you aware what the number was?
A little over 50,000, or a little over 50%.
So the vacancy continued on from 2018 to 2021 then?
No, this was an advertising in 2018. I believe they were, if you look at the Johnson report, it highlights it pretty well. 125 Gary, they were at 5.9% in December of 2018. All my referencing is of that end of the year. And then it increases in 2019. By the end of 2019, they're at 50%, and by the end of 2020, they're at 51.5%.
Okay, so in late 2018, they knew 57,000 feet was available. And from that time until the reference date, there's no evidence to suggest they filled it up, is there?
As far as recent activities in the building, you see from the ID that was submitted, with the rent rolls that were submitted. They did get some tenancies in the building.
And what page is that?
Page 39 in my brief. Well, on these January 1st of 2020, they occupy approximately 10,897 square feet, so about a floor plate at $14.
Okay, so that was
Now, hold on, please let me finish answering. Then you look at CRU, which is 750. Stephen and Rosenfield, they occupy approximately 2,337 square feet. January of 2020, and they are paying $9.20. They actually occupy another unit at 1,561 square feet underneath that, highlighted in yellow for your convenience, right on January 1st, 2021 at $14. Then on unit, CR unit 850, they occupy 3,657 square feet at a rate for October of 2020 at $9.15. And then they escalate in 2021 to $14.50. So it seems there is a bit of tenant inducements to get people in the door for two of the tenants, and then they go back quickly to market, or Wawanisa came in right at market.
You're not aware that Mr. Rosenfeld was in the building prior?
I'm just reporting what they're showing on the ID.
All right, and on this section that you referenced to us, have you added up the vacant space?
From the listing?
No, on the page 39 that you directed us to.
Well, we have under appeal on the building, and we're quite thorough when we're at the municipal board with it. It was 113 approximately. But when you actually add up the actual vacant space and the total space, and I had some questions for you regarding this, we come up to 123,177 square feet for the total useful area. You can see that on page 40, and that's the total.
That's not the question.
No,
did you add up how much they've reported? You asked us to look at page 39. My question was on that page 39 in that rent rolls, have you added up the amount of vacant space that they're now saying as of December 31st, 2020?
No, I didn't numerically add up each individual CRU.
Now, I've just added it up. Do you disagree that it's 63,226 square feet vacant?
That's what your number is.
Okay, so just to recap, in 2018, they believed 57,000 square feet would be available. By 2020, they have 63,226 square feet available, according to your evidence. Is that not correct?
These are simply the listings that I'm showing. I'm bringing in the rent roll, which is showing reflective of about a 10,000 square foot increase in leasable area. So
10,000.
Depending on what vacancy you're applying and what total leasable area, you're going to skew that number a little bit one way or the other. I think we have to look at what the actual leasable area is. And it appears to be 23,000.
Do you see the heading on page 38, 39 of this report? CPM commercial rent roll?
Yeah.
So that, you may not know, this stands for Collier's Property Management. And the other report you directed us to was Sean Cleaver's listing of the property. So Collier's prepared both these documents. So are you suggesting that we didn't declare the square footage correct that is vacant or available?
I'm not sure. I'd appeal. We had 113,000.
Okay, Mr. Polo, it was a yes or no.
So no.
Just please answer the question.
No.
Okay. In regard to the parking on your page, sorry, let me get to that. I believe that's page 13.
41.
Page, I'm looking at the so let's put it upside down. And these things. Okay, I'm looking at page 13.
Sure.
Now, on this page 13, you list 14 properties, and of those 14, my count is 10 of them offer casual parking. Is that correct?
Approximately, yeah.
And does the subject offer casual parking?
No, from my analysis and what we went through, it is close to market.
Just does the subject offer casual parking?
Yes or no?
No.
Okay. Does not the additional income from casual parking make a difference in the value of the parking area?
From a leasehold perspective, it may lessen it. From a fee simple perspective, that's how we're assessing it on. It would be an increase there too, but that is operating strategy. So yes and no, depending on how you operate it.
You mentioned fee simple. Where does that terminology come in the Municipal Assessment Act?
Fee simple is how we assess our properties. It's common knowledge. If you're indicating you're not doing a fee simple approach, it's indicated. I'm going with what we're doing.
That wasn't the question. Does the Municipal Assessment Act, which governs the assessment procedure in Manitoba, does it ever reference fee simple?
The act, no. Case law, numerous times.
Okay, it was a specific question. In the interest of time, we're still on the first one. We've been on it almost an hour. Let's just not have arguments and try to proceed and answer.
No.
Thank you.
In your discussion, you mentioned that you used the Johnson report, and I believe that you were referring to page 14. Is that correct?
Page 14, as well as the indices on page 18 through 19. Okay.
And in this page here on the Johnson report, this is the black page, page 14. I'm just trying to see, you're indicating a vacancy average. Is there a classification that you've selected in Johnson?
Class B buildings, OFB.
Okay, no, but you're saying OFB, that's an assessment term, correct?
It is synonymous with Class B. Class B is OFB. It's industry standard. Anyone in tribunal knows that.
Okay, well, let's not go there, but my question is are you suggesting today that the Johnson report Class B is the same as the assessment department OFB?
Primarily, yeah. We use the same BOMA standard. They use the same BOMA standards. It's in market reflection.
Now, does the Johnson report have variations in Class B?
If you're asking me how the Johnson report enters this in or classifies their own properties. I can't really answer that. I'm not the author of the Johnson report, but generally they reflect what the ownership groups are advertising their properties for classes, vacancy rates, asking rates, as well as shortfall. So,
have you not heard the term of B plus, B, and B minus in the description of Class B buildings?
I believe I went over this many times. B, average B, lower B, B plus or prime. Yeah.
Has your assessment department ever received a classification guideline from Mr. Johnson or from his predecessor in the report, Ken Croach?
I couldn't tell you that to my knowledge. I don't know that answer to that question.
In regard to so your workup, to be clear, was based on a hypothesis that the building was full. It is not based on the statement on page 35.
Not sure what you mean by hypothesis.
Well, a hypothesis is something that's not true, but it's an assumption. Now, it's true that the building was half empty, so I think it's fair to use the word hypothesis that it has been leased out.
You mean our assessed value?
Yes.
The assessed value is not a hypothesis, it's an assessed value. I looked at the property.
Okay, guys, we're not debating hypothesis. You understand the question. If you don't understand the question, Mr. Neufeld, please repeat the question and let's answer it and move on.
Does the hypothesis of the or assumption made in the assessed value calculation, does that match actual experiences?
As far as the stabilized vacancy?
As far as income and vacancy?
We're doing a market-based approach. It's based on the marketplace, not a leasehold approach. We're doing a fee simple analysis, not a leasehold analysis.
You do understand the terminology of hypothesis is that if it is not actual.
Okay, let's move on to hypothesis. Okay.
On page on pages 35, 36, and 37, do you see what the owner has reported for the actual income? And I'm looking at the net income of $639,000 on page 37.
Yes, I have. It's highlighted in yellow.
Oh, 630.
Yeah, sorry, it might not be highlighted in yours, but yes, on the bottom of page 37, net income loss, positive 639,000.
And that compares, we're talking about the same thing. That compares to your conclusion on page 5 of 1,315,000, or approximately twice as much. Is that correct?
Numerically, that's about what's been reported.
Now, on your page 3, you've allowed 3% for non-recoverable expenses. Is that correct? The 39,943.
Correct.
And did you have a chance to compare that to the actual performance in the subject property, which would be on page 37?
Yes, I did.
And their number is $53,375. Is that correct?
Correct. Yes.
Okay. Yeah, as far as capitalization, I understand this was derived from the model. To your knowledge, how many Class B buildings sold in the 2 years prior to the reference date?
I don't believe
that were investment quality.
I don't believe any. The ones that I have in the brief are the last ones that I'm aware of.
And that, of course, is also our understanding. So how does one derive a cap rate with the absence of sales?
I just indicated to you that there was the best evidence of marketplace. Those are the best and last indicators of cap rate. We indicate that the interest rates have been steadily declining or very low historically leading up to the reference date. You would expect that to be at least at the same rate.
Well, the legislature, in their wisdom, determined that properties should be reviewed every 2 years. Did you not think it would appropriate to consider the impact of issues like COVID on this property for the 2-year change?
Again, when you look at the marketplace, what we lead up to 2020 include any issues with COVID as far as vacancy, asking rates, as far as non-recoverables, as far as shortfall, which are all exactly what's been indicated on the items.
Except for this subject property, of course, which is indicating half the income.
When you
Correct.
experience about half the vacancy, that is an actual experienced leasehold vacancy. We're
Did you
doing
make-
a simple valuation. Marketplace.
Did you make any inquiries from the people who you quoted or who signed the income and expense form as to whether they're undergoing any recovery?
As far as from COVID,
No, as far as financial recovery, income recovery.
define what are you talking about for as far as recovery? What parameter are you looking at? The overall?
I'm talking about filling their building up. Did you check with them if they've managed to fill their building up?
As far as all the parameters, we have an expense statement that are signed to be and authorized to be from first-hand knowledge of the property owner or manager to be complete, true, and accurate. When we get that information from the property owner or from the managing, how that to be for the property owner, we take that as to be complete, true, and accurate. So we don't need to contact 660 CRUs, tenants, or the property managers. They've already done that. I've also backed that up against the actual Johnson report, which is advertising out to the marketplace what their actual vacancies and rates are.
Did you not state in your presentation that you were considering the stabilization and that I believe you used the word, there was a blip prior to 2021. And now, since you're considering it a blip, I'm wondering if you have any information that would suggest that it wasn't a permanent change, a permanent loss.
Permanent loss of what, vacant, like space?
It was your word, blip, the performance, the high vacancy.
The high vacancy is stabilized under market rent leading up to the reference date, escalating when one tenant left for about a year and a half, 2 years.
Right, now, if you're stabilizing it, don't you have to have a reason to believe it will stabilize? Do you have that reason?
As far as I see no barriers to market here. You see that they were 100% full for a significant timeline. You see that they're advertising their space, so it is available to market. So there would be no indicating that there'd be a barrier to market coming back in. They simply lost an anchor tenant.
So for a period of at least 2.5 years, that's of 50% plus vacancy, no adjustment then. Is that correct?
I give a 2% increase over market of 11%.
I'm going to leave this to Mr. Mercury. I think he has some questions.
Thank you, Mr. Mercury.
I think having listened to Mr. Newfield's questions, I think we've covered the subject area. Those are our questions.
Okay, thank you very much. Mr. Diamond, do you have any questions?
Yeah, I just think as far as the parking income is concerned, I don't see show a net, but you don't show how the expenses were arrived at. How does the model determine the gross rent and the net that you're basically?
As you see on page 13,
Yeah,
those are net install rates per month. They
Right.
take the expenses out, those are the comparison.
I know, but we don't know what expenses
But
are,
it's-
so.
But as far as the expenses are from the model perspective, it takes it straight off. So we were showing a net operating income per stall on a net basis. So no.
So that's something that the model just does. You don't have any impact on that.
No, as indicated for the 330 St. Mary's, I did the entire NC of 171, which is basically North Portage or South Portage, North Broadway, in between Main Street and Memorial. I did the expense ratios for 3 years, the entire marketplace, and then indicated a bit greater than what the model was. That's why I asked for 115. I haven't done that for this time period. So we're relying on what the model is, which is a little bit below what I found to be. But no, as far as the expense ratios, I can't give the definitive what it is because I haven't done that analysis for this cycle yet.
Is there a vacancy formulated by the model in that final determination? Because we know that there's less tenants. So I'm assuming if the tenants are people who park in that lot, there might be less people parking in it.
Due to COVID, is what you're indicating? From due to COVID?
Well, it could be due to COVID, it could be anything.
Yeah, I think
I'm not going to tell you why there's a vacancy there. We know it is. I'm not going to speculate on what caused that vacancy.
It would be reflected in your gross income versus your gross expenses.
Right.
So that's how you essentially come to it.
So the model would take that into account.
Well, you would reconcile from that approach, but you'd also have to look at the cause of the vacancy, given COVID, which happened. You wouldn't expect that vacancy would occur on a long-term basis. So any property owner or any potential purchaser wouldn't look at that marketplace and think that they'd be empty for considerable amount of time in the future. So it just, COVID is what it was. So
Okay, that's my question. Thank you.
Thank you very much, Mr. Hutchings.
Yes, thank you, Marla. Mr. Pohl, good afternoon. My first question is on page 11. Mr. Neufeld had asked you about whether the parkade parking structure had casual parking. Page 11, the picture there is, what is the building next door, I guess, to the right of the parkade?
if I'm not mistaken, it's the keg.
The keg, okay. Now, what's the definition of casual parking allowed?
You can casual parking, transient parking, hourly parking. You could pay weekend, that kind of thing, event parking.
Is this parkade used as an overflow for the keg restaurant at all? Or in other words, casual parking allowed, for instance, in the evening?
I couldn't answer that from what indicating from the review that we did leading up to it for the municipal board appeal. I would say no. It's managed for the building itself.
Okay.
Participate in the marketplace, that's an operating strategy versus it's an own self-imposed barrier to the market based on how they're operating it.
Okay.
Whether at the moment at the reference date, that's up to Mr. Neufeld to answer.
Okay, thank you. And my next question, my last question actually, is regarding the listings. What page are we on? Page 20 through, oh boy, how many pages have we got here? 20 to through 25, I guess. 26. Yep. Are those recent listings? Like, is there a detail? I think you said the first one was for 2018. Is that right?
2018. Typically, the department reviews listings and they put them per year. So anything post reference, I don't look at. If it's 2021, I don't. Not the spring of 2021, obviously, but anything post reference, I simply don't review. So we categorize it by year. These would have been for both the reference date.
Okay, so the space is still being listed. Would it be fair up into 2020? I think Mr. Neufeld stated about, I'm going to say around 60,000 square feet, give or take. They're still listing it for $14 a square foot. Is that right?
Yes, and if you look at the Johnson report cross-reference on the vacancies on pages 18 and 19, they indicate it has been 0% vacancy up until 2018, which is at 5.9, and they put themselves in at market at $14.
Okay. All right. That's my only question. Thank you, Marla.
Thank you very much. And my questions have been answered. So, Mr. Neufeld. Sorry. Mr. Neufeld, Mr. Mercury, please proceed with your presentation when you're ready.
Sorry, I was just checking a quotation. Page, you have my report, and there's also some rebuttal information that we had submitted for whenever we get to present it. Page 1 is our workup. In a nutshell, the major difference is obviously going to be vacancy. We're using 123,000 square feet. I don't know where the assessor got his information from. We're going from the rent roll. And I imagine it's an issue of counting space. I think in this particular instance, there's some maybe some basement space that's finished that has been included in the rentable, which might be the variance. I don't know, but you know what? It's not my problem. It's not my issue because I'm reporting what the owner reported. The rent we're using this is rather surprising to explain this, because they had a tenant, Ceridian, who had a lease out clause, and it was exercised in late 2018, and they vacated all of their space. After they vacated, and with some of the renewals, the average rent rate rose, because Ceridian was in at $9, and it had dropped down the rents. So we ended up using the average of what of the remaining tenants, because that was the rent. And then in terms of calculating a vacancy, at the time in April 1st, 2021, that actual vacancy, this is about the middle of the page, was 51.33%. Consulting the Johnson report, we noted that downtown office was at, and I just want to let you know, first of all, I'm using the June 2021 Johnson report, and I'm very satisfied that this information is not post-reference. I've spoken to Mr. Johnson several times. He amasses the information up to about January, and then begins his editing and printing of it, and then it publishes it in June of 2021. I have the document in front of me. There's not a single transaction in here that's dated after January 2021. And as you may know, he actually lists all the transactions on the pages. Oh, there's one right here. No 21, it's all 20s. So he's got downtown office in his workup at a downtown total. I gotta find the right page. That doesn't seem right. He's actually at 13.4. And I don't know why we use 9.9. That must be a typo. He's actually at 13.4. He's got his Class B at 13 and his Class C at 20.2. This, just in my head, won't really change our math much, but we just kind of looked at these and took the mean. So if the low end was 9.9 and the high end was 51.3, the mean is going to be about 27%. This is a method of looking not only at the individual experiences of a building, but also at the market, and trying to come up with a blended idea. Some buildings perform better than others, some perform worse. They're not all created equal. So the actual experience has to be taken into account. And the actual vacancy, 51%, we're using 27. That's the way of stabilizing, is don't ignore the actual experience, take it into account and look at the market. There's our biggest area. And as you can see, when you work through the numbers, our NOI is $1,048,000 as compared to the actual NOI of $630,000. So we are trying to weigh this over time. And the major issue here, though, is that there was better performance in previous years, but there has been no recovery. Now, that is post-reference. We can look at post-reference in terms of confirming a trend, not for value for determining the market. The trend is something that started well before COVID, was the change in the office neighborhood and the concept of downsizing office and more at home. COVID just made it happen, and it's not going back. And that will be in my rebuttal. So we anticipate that on a long-term basis, vacancies will remain a major problem with this building. In terms of the non-recoverables, we're using 5%. You did hear me ask questions earlier about the actual experience of non-recoverables. They were in and around that number. as to the assessment department's calculation of 3%, I point out that we are doing our own study, and that's listed on pages 48 and 49. I'm only halfway through our portfolio of managed properties, but 125 Gary was the subject of, was included in that, and that's on page 48. So in 2017 statement, they were at 10.65% for non-recoverables. And 2 years later, December 19, they were at 4.43% for non-recoverables. I do not have the 18s. I was just going off the main assessment year ones that are used for the assessor basis his workup on. The mean of these properties is, it's not on this, it got cut off, it's about 8% of non-recoverable costs. And what is important here is that this is not a hypothetical number, this is cash. So if you're an investor, you want a return, whatever that return may be, you don't say, well, we won't count the non-recoverables in there. They do, because somebody has to pay them. They come out of the proceeds, they come out of the profit. And the concept of non-recoverables also takes into account the structures of leases and the type of building. So these are real costs. And the text on this, which I believe is the same course that the assessor may have taken, was very clear on what should not be included in a statement, what is not an expense. And everything is an expense except depreciation, tax considerations, income tax, corporate costs, addition to capital, or loans. Those don't get included. Everything else hits the bottom line, hits the revenue, hits the expenses. That's pure theory that everybody in the world applies, with the exception of the last 5 years of assessment cycles in Winnipeg. The rest of the world has to apply it. So our shortfall is on the low side, and that's because the building is a poor performer. So the upkeep isn't there, and the taxes are lower because it's in a depressed state. So the shortfall goes lower. So why I'm pointing that out to you is because this isn't a cherry picking exercise where we would like to have just the good things applied to us. We're not going to say, oh, we like the assessor's vacancy or we like his shortfall, but we'll pick our own somewhere else. Assessor's got a shortfall here of about $12. It's not $12, it's about $6 something. So if you're looking at actuals, you got to be honest to your valuation and use that. The parking structure income is the actual net income from the statements that is being generated. And the point here is that it's a closed shop. When vacancy goes down, sorry, when vacancy goes up in the building, it goes up in the parkade. It's the parkade is there for security. Now, I know at one point in their darkest hour, they tried to get casual parking in there, and they had a sign up for a while. And I asked, how much are we generating? And they said, well, about $5 or $6 a day. It's inconsequential because there's no one who wants to park there anymore. It can't do casual event parking, like for example a Jets game, because it's too far away and it's too cold. And I heard one of the members ask about the keg. Well, you know, the keg's been closed for lunch for the last 4 years. So when people go there at dinner, there's a lot of street parking available. They're not paying for parking, even if it were available. And that's the nature of Gary and near Broadway. There's no demand for other parking, right? And if one wants to rely on parking rates from other locations, then one needs to adjust them properly for their location. In our analysis, of course, we had some other, just going back to the concept of vacancy on page 10. We were just tracking, and these are the other buildings being looked at today, and their experiences aren't that much different than the subject. But you'll note that they didn't start when COVID hit, they started before then. And that's when problems started to happen. It's a continuation of a trend on page 10. See, I was right when I said he used the wrong vacancy rate. Now at the page 11, first calculation. It won't matter to our workup. There are some pictures on there, and they show the vacant space. Some of these spaces were vacated by a tenant. For example, page 13. The top picture, the tenant just left behind their stuff and ran. The bottom of page 13 is the little Jackpot Cafe, which was closed and might still be closed, and that's their stuff. Page 14, again, this is Ceridian space. They vacated, and we were in there taking pictures after they had vacated. They left their partitions in, and page 15 shows their space on the first and second floor with a lot of partitioning walls still in place. They're still there. There is a long shot hope that the next tenant in might want to use that in their demising, and might save them the cost of hauling it to the dump. Page 46, you heard me ask the question about investment sales. This is every office sale, page 46, reported in Sabre. There is one in there that potentially could be an investment sale, which is 379 Broadway, but it's it's not a good building to choose. We're not entirely sure that the transfer was arm's length on that sale. So and that's a D building. So there was nothing. So when we went to cap rates, we were relying on a very different I shouldn't even say very different. It is the basis for the original method of capitalization was as a number of basis points from the lending rate. And on our cap rate study, this is page 34. This is what we look at. What are the bond yields and the Government of Canada bond yields, which and then look at the basis points to an average cap rate. This is a national chart, by the way, and it shows that over time there is a relationship of 400 basis points. And we then explore this a bit further in the Canada cap rate, page 36. That's actually a blow up from there, shown on page 38. So in our calculation on this basis, you can see downtown office, page 39, ranges from 6 to 6.75. That is our estimate. No sales, estimates. And this was done with the participation of several people in our office. And primarily, this has been based on our investment people. Now, page 43 is the Collier's Debt Advisory Services report. The need for this came out to try to inform the market that it doesn't matter if you think a building sold at 3% or 4%, it didn't. That's not a real cap rate. A real cap rate has to meet one major criteria, which is it has to show that there's enough income to pay the mortgage, period. It wasn't created for appraisers or assessors. It was created for bank managers. It's a test. It's like going to a bank and qualifying for a mortgage on your house. That's why a cap rate exists. You do not have that spread to the interest rate. You do not have a cap rate. You have an investment that was made for a different reason, probably something well into the future. And this whole report describes the methodology and the different indicators that are used. Now that takes us back to page 2. And so essentially page 2, from the Collier's cap rate, the best rate one would expect for a downtown office B is 6%. That's for the best property. This isn't the best property. It's actually at the lowest end of B. It's a B minus. And this, of course, B minus was labeled this way by the market, not by people who don't know anything about it. I would not profess to be a rater of buildings. This was done by people who have to lease them, and what people are looking for, the amenities. In this case, the rationale was simple. It's off the beaten path now. It's not on the pedestrian corridors. It has no real amenities, and it's dated with a bad floor plan. So when one looks at this at a base rate of 6% on page 2, the first adjustment, of course, is that the Collier's cap rate report includes closing costs, which would be land transfer fee and commissions. They artificially raise the sale price when we calculate a cap. So by taking them out, you bring it back to the appraiser's world, to the assessor's world, which is we don't include those costs in our cap rate analysis. And what we've done in our rating scale is put on rates. So this was done in discussion with appraisers across the country in Canada. And I think I may have mentioned in the past that this actually began in Kelowna in 2010. And over the years, we've been working on this to try to find a transparent model for explaining cap rates. Kelowna meaning a meeting there, not the city of Kelowna. Now, if we put a weight on the closing cost of 3 points and then we change it to 0, what we're doing is that 6.6% becomes 6.15%. That's the math. And that's the start point. We then have locational issues, downtown center and Skywalk, the year built, tenant strength and income stability have just been pathetic. So that's the major factor, and that gets us to 7.5. And I think that this is a very fair workup for a building that is in obvious distress. And other than my rebuttal, that's my presentation.
Thank you very much. Mr. Paul, do you have any questions for Mr. Neufeld regarding his evidence?
Yes.
Oh, sorry. Wait, Mr. Mercury, did you have anything to add? Sorry. You're
Nothing
so
further,
quiet.
thank
I forgot you were there. Okay, sorry.
Trying to streamline this. Nothing further, Madam Chair.
Mr. Paul, go ahead, please.
On page 1, you indicate 27.74% as far as vacancy, correct?
Yes.
That vacancy is sourced from where in your brief?
Down below, as I was explaining earlier, we looked at the actual vacancy and then market reports.
So you expect that this property to remain on an indefinite long-term horizon for investment vehicle to remain at 27% vacancy for an potential purchaser?
I think that would be the appropriate number to apply, given its history. It's shown no signs of recovery. We believe that this is fairly permanent factor.
So leading into the history that you just spoke to, the history for as long back as I've looked, it's been a negligible vacancy near 0 or at 0.
Well, no, that's not entirely true. It started its life off as an owner-occupied building and then moved into being leased. That owner occupant gave up half their space and put it on the market. So essentially there were 2 users, Ceridian and Western Canada Lottery, as well as a couple of small ones, which really added nothing to it. So for years, it's just been, if Ceridian or Western Canada Lottery made a change, then there would be a massive vacancy. And for those years, the rents were $8, $9. So they were fairly good rents for them. Then once Ceridian pulled the plug and left, the building shows its true colors. There's no interest without that original owner occupant input.
Speaking to the parking, is the parking open to market? Can anyone park there?
When I checked it, a year ago, it was inviting casual parking, and as I mentioned, that we then looked at the revenue that came from it, and it was nothing, and it was again $5 or $6 a day. And now we did not have a breakdown in this statement. I believe it's just the total number is in here.
So that would be a leasehold valuation of the parking, correct?
No, I mean, this is a fact of life. Nobody wants to park there. That's the market. And it's based on market derived issues such as the location and style.
Hey, on your side, your income, your rent roll. Wawanesa is a knowledgeable and sophisticated tenant in property or in marketplace. They're paying $14 in 2020. The other two tenancies within the building appear to be a short-term inducement to get tenancies in, and they're approaching the vacancy, or they're approaching the market as well at $14, similar to Wawanesa. Why are you saying that there's no interest when you have a primary tenant in the marketplace occupying the building on a full floor basis?
Well, you've made a series of assumptions there. One on whether or not someone is knowledgeable or not. And perhaps you don't know anything about the motivation of Wawanesa's presence in the building, but they have mothballed their building nearby, and they are doing other premises, and their other building at 200 Main is now changing as well. So this is not what one considers to be a major deal. And if you look at it, you can see that they renewed in 2020 till 2023, which is a very strange term. It's a short term while they're moving to other premises. So you would call that a
4-year term.
You would call this a shorter than normal term, so that would be a termination deal.
It's a 4-year term, correct?
Yes, sorry, 4 years.
Page 7. This is a listing with Collier's, correct?
Yes.
$14, triple net.
That is the asking rate, yes.
Okay. Your BOMA certification, what is it?
BOMA, I'm not sure. I don't think that's a factor on value.
We ran over this in detail at the municipal board. It is silver. You're aware that it is silver. You had a guest speaker speak to it, Mr. Collier, as in it is silver. You're clearly aware of that.
Okay. Well, you're testing my memory. I don't recall because it's irrelevant to the rental value. But if you say silver, that's fine.
Would I suggest to you also that the building has received upgrades to it over time, and it's a winner of the Toby Award as well?
Well, it's needed upgrades over time because it's fallen into a level of deferred maintenance. So if you take an old car and fix it up and brag about it that it's upgraded, it's still an old car.
So page 9, the comparable office rents. You have 1, 2, 3 rents inclusive of the subject property. So realistically, you have 2 rents, correct? Of all the fees, Class B building. The rest of the rents are not applicable to the property. It's not a bills on Class B buildings.
Well, okay, but that's I disagree with that statement. And there are, I note here, 2 other Bs, as well as the subject itself.
Did you do a full exploration of the marketplace similar to what the assessor brought in? It's readily available? Or did you just bring in 2 other properties outside of subject property?
Well, the best evidence what a property can rent for is the history. And, you know, I'm a little puzzled by the question. I don't understand really I'm looking, I'll tell you what, I'll defer to your number, 1350 instead of my number of 1352. What's the issue here?
The rent associated with the risk of vacancy. Did you tie that associated to the risk of the vacancy? Is there any relationship to your vacancy 27% versus the risk of a rent at $13.50 or $14?
Well, as I mentioned, what we were using on the rent is what the remaining spaces have been able to generate. Ever since Ceridian left, the average rent popped up, and now it's $13.52, and you're at $13.50. You know, I really don't. I mean, I'm not questioning. You can ask any question you like. I'm just rather puzzled by that question as to the relationship, the vacancy. Of course, asking rent will have a bearing on vacancy. If they put it at $5, you might have a few more interested people in it. They're trying to market it, trying to get a big dollar, no interest.
Page 10, your vacancy rates for Class C and D downtown offices.
Sorry, page
10.
10.
You've already stated.
There are a variety of different classes in answer to the question. I said there are a variety of different classes in answer to your question. That is correct.
I haven't asked the question yet. 125 Gary, 215 Gary, and 175 Gary are Class B buildings, are they not?
No, 125 and 215 are B minus. 175 is C plus.
B average minus B or B prime B plus. They're Class B buildings, correct?
We're differentiating them a lot differently than your question. I said 125 and 215 are B minus. 305 is a C. 175 is a C. 428 is a D. Edmonton is a D.
So as far as the vacancy asked for, you see 16.4% for 215 Gary, you see it at 2%, 2%, 11, 11, 15, 175 Hargrave, you see it at 5.4, 6, 15, 7, 7. You see that those aren't at a 50% vacancy, correct?
No, they're not. Well, 215 Gary is slightly misleading in that we're still waiting to determine if MIT is extending or leaving, and that number could hit 30%.
Again, that would be post-reference.
No, it isn't. It was known about. They've established that they're going for. They're changing their space.
Page 11.
It's a question of how much they're going down by.
Page 11, as well as pages then on pages 16, 17, 18, and 19. Entirely the Johnson report. This is from June 2021, correct?
It was published June 2021.
Would the marketplace be able to read Mr. Wayne Johnson's report as of April 1st, 2021?
Pardon me? You cut out there.
Would the marketplace be able to read and essentially get Mr. Johnson's report as of April 1st, 2021?
I'm not entirely sure. I don't understand. That's not the point. It's from data amassed from January of 2021 and before. Date of publication is irrelevant. It's not a market document. It's a market report. I was reading a book about the Crusades. It was written last year, but they happened in 1192. I don't think anybody cares about when it was published.
So in other words, yes, no one can read this until June of 2021, and it is post-reference to any reader within the marketplace, correct?
No, that's not true.
I believe this has been asked and answered. Let's move on to the next question.
starting on page 33. And then on page 4, this is synopsis of, correct? And leading up to, maybe it's putting backwards, up to page 36, 7, 8, sorry, up to 38. That would be Canada-wide, would that not?
Which page?
Pages from 34, sorry, 33 up to 38. That would be Canada-wide, not local Winnipeg marketplace.
It's a mix of national and local market.
So capitalization rate, risk grants, and everything that goes along with it for the entire nation.
Specifically, what are you referring to? Because each one of them is separate.
Pages 33 to 38 appear to be from a national report, which would be inclusive of the entire country, not Winnipeg exclusively.
Well, that's not correct.
Can you tell me where it indicates Winnipeg? Because when you look on the bottom, it indicates the entire country, every major city.
Certainly. Top of page 33, I wrote, that's Winnipeg. The descriptions on multifamily, which probably shouldn't have been put in here, is from the national standards that apply to every province, every city for describing what's to be included. Top of page 34 is our national rates, and of course interest rates are national, so that's appropriate. The disclaimer is global. Page 35 I wrote, so that's Winnipeg. 36 is a cover. 37 is a recap of the world, which is appropriate to all of Canada because we're all dealing with the same issues. And the repeat on page 38, this is a national perspective, and it's a theory. It's not about market, it's a theory that says that you better have a cap rate that matches the cost of borrowing money.
So this is not direct evidence in relationship to Winnipeg.
Pardon me?
It's not direct capitalization rate evidence in relationship to Winnipeg. It's a national average.
And it's not a national average, it's a national test of sanity of cap rates. Winnipeg doesn't operate in isolation, nor does Montreal or Halifax. This is appropriate to anybody investing, and should you do research in the United States, you will find that this same theory is now being very heavily looked at to try to bring back sanity to crazy cap rate reporting.
Page 59. For Winnipeg itself, Class B, what is the low and what is the high capitalization rate according to others?
Downtown office for which category?
Downtown office, Class B. Is it not
Right.
below 5.75?
Well, those are the broker's rates. And as I explained earlier, the broker's rates don't calculate the same as the appraiser's rates. So there's a variance. So it would be 6.15 to 6.9 as a low high for B.
Moving on, page 43, inclusive from page 43 up to page 45. This is dated August 2025, which would be post-reference.
Sorry, what page is that? Page
43, 44, 5.
It was published then, but that's not what I'm looking at relying on. I'm looking at the graphs, and one can easily look at the graph Q1 2021 and see where those trends. So it's a historical time. So
Yes or no?
no, it's not a yes or no. Avert your eyes. Don't look at 2021. That's the answer.
Page 48, 49. Income statements. You have looked at these statements yourself?
Yes, this is my work.
So you've explored 125 Gary, which is the subject here.
That's correct.
200 Portage, which was a building that was bought, empty building, correct? And he's recovering from an owner occupier selling the property, vacating it?
No.
The residual.
No, it's not correct.
I reviewed this with the property manager who's filled out the sales questionnaire. They bought an empty building.
I don't believe that you have, because they're a client of mine and I've had the opportunity to speak to vendor and purchaser, and your version of events doesn't match reality.
It matches the IE, or it matches the sales questionnaire and the follow-up question, the verification for the management at the time. So
I apologize for being argumentative, but it matches your version of events, not truth.
Okay, I believe the board understands
Thank you.
information provided by both parties.
330 St. Mary's is another B, correct?
330, you said? You clipped out again.
330 St. Mary's, another B.
330 St. Mary is a B, yes.
And then you have 175 Hargrave, which is again another B.
I don't think I'd call 175 a B. It's attached to a B, but amenities are a little bit lesser. So I think it's probably in our marketplace a C.
So overall, the income streams that you've examined has been a small fraction of marketplace.
No, what I've examined are ones where we have accurate data. All of these are managed by Colliers, or we have their full statements, and they're net buildings, and therefore we can do this analysis. It's an overview of the marketplace in general, and the concept of it was prepared to demonstrate non-recoverables in all forms of real estate as exist. And this is what they are. And as to specifics, I think that the office fall into the category of all the rest of them. There's some lows and highs. The idea here isn't to say we're picking one and putting all our weight in it. It's common sense. You brought up 200 Portage. 1 year, 0.5%, next year, 33%, because there was a vacancy, there was a changeover, there were costs associated with it. And we don't go along and say, give me 33% non-recoverables. The theory is simple. Cost non-recoverables go up, they go down. They get stabilized over time. 5% non-recoverables, 2% replacement reserve is very well supported by this as a stabilized number.
Last few questions. This property was not managed by Colliers at a point in time. Colliers took over management. From Colliers managing this property, has there ever been a point in time when this property was not advertised at a $14 net rent rate?
I have no idea on what it's being advertised at. I know that it's been an uphill battle to try to get tenants in there since we've taken it over. And I imagine that, no, I don't imagine, I know that one of the reasons we're managing it now was to try to get our better track record of securing tenants in buildings.
So you've had it under appeal at the municipal board, reviewed significant amount of time. You managed this property, you looked at financial statements, and you can't confirm that it was ever advertised anything less than $14 or anything greater.
I don't know. I mean, I've seen the advertising for sales, but particularly for rent. Again, the relevance is important here because an asking rate is not a market rate. The market ends up deciding what that rent might be. And with the application of IFRS, which will probably be heard later if we ever get up to it, is treated in a different manner on the tenant improvement side. So then average net rents will actually go lower on that basis. This building could potentially rent for that, but it would likely take, I've interviewed the leasing agent several times. They anticipate having to spend about $30 to $40 in TI in order to induce someone. So on a 5-year term, that's $6 to $8 a foot in TIs to hit the 14. So that's not good numbers.
More questions?
Sorry? Hello?
Can you repeat this?
I think that it was indicated that there's no more questions being asked by the.
Sorry, it keeps cutting out from the boardroom. Sorry. Okay, thank you very much. Mr. Diamond, do you have any questions?
No, I think that not. I think all the questions I would have asked have already been asked. So thank you.
Thank you. Mr. Hutchings?
I do, but I'd appreciate it if we could just have a yes or no in the response. My first question is, Mr. Neufeld, do you consider this a Class B building with some variations in minus to plus?
Yeah, we don't do the B anymore. We do B minus, B plus, or B. It's a B minus.
Is it still a B?
A B minus.
It's not a C?
No.
Okay, thank you. And leading from that, I would ask vacancy actual just below your workup. You've got a Class C mean in there. Did you mean to put a Class B mean in there?
Yes, and I alluded to, or I stated
Yeah,
that earlier and I did the math in my head, and I don't think it makes a difference on our number, because the if you look to page,
I think it'd be dropped down to, am I right, 14% for Class B?
yeah, page 11.
Yeah,
the B is at 13.
13. Okay, that's
yeah.
all my question. That's fine.
But the
Okay, thank you.
Thank you. That's it. That's all my questions, Marla.
Okay, thank you very much. And I have no further questions. Okay, excuse me, sorry. Mr. Neufeld, you indicated you have rebuttal evidence?
Yeah, and it was just this very interesting article.
I'd like to object to this. This is post-reference. It's clearly dated September 2022. And if there's going to be consideration of post-reference material, I'll object at the moment so that we don't waste time and talk about post-reference information. The board hears post-reference information.
Sorry, and what would be the evidence to suggest that it's post-reference?
Date that it was released on. You can read it in the article.
Okay, so we don't get to write about history anymore.
Okay.
I told my Crusades joke here.
Yes, you did. That was a good one. Okay.
I'm pretty sure when I explain it to you, you're not going to find that there's anything post-reference in here.
What article is it? Because
it's called Reimagining Office Space.
Midway down, posted
Okay.
September 2022.
yes, I have to find it for 1 minute. Okay.
It's at the very end, Madam Chair.
Yes, I found it. It's just loading.
Okay.
Oh, there we go. Okay. Okay, if you're objecting to it, I will have to take a brief recess and speak to the
Sorry, he's objecting to it. The article speaks about 433 Main Street. And it talks about the history of 433 Main, and 433 Main took out its permit for renovating its space from office to residential in June of 2020.
Can we see the article and make a judgment on whether we're going to accept it or not, please?
Yes,
I'm putting it into context.
Okay, thank you. Please just give us a few minutes. We're going to discuss it.
Yes, Madam Chair. We're live, Madam Chair.
Thank you very much. Okay. The panel and I discussed the article and the assessor's objection to it, and we have decided we are not going to allow the material. So then,
Sorry, I was just going to put in the background information I had mentioned. This refers to an incident from June of 2020. It is not a post
yes,
reference.
we're not allowing the article. So we're
right.
going to move on to summaries. Mr. Pohl, do you have a brief summary?
Summary. The issue here indicates mainly in the vacancy. There was a large 10 anchor tenant that left. Approximately half the vacancy occurred within about a year and a half, approaching the reference date. Order 330 St. Mary's specifically addresses such as an anchor tenant left there. The board awarded market rents with market vacancies. Similar here, I've awarded a bid bump of 2% to the overall market, given the situation of the building being an average B, and the rents that are associated with it and what it's being leased out as. With that, there was other post-reference information that was indicated in the brief and spoken to by Mr. Neufeld. The Johnson report being released in June of 2021, that is clearly post-reference, and vacancy occurring currently in the building, which is clearly post-reference. I'm hoping the board puts no weight to it. I'm not sure how the panel wants to address this moving forward, if we were to object on the moment that it's being presented or simply make it a preliminary matter. I find the process of spending so much time on post-reference information that shouldn't be heard or spoken to takes up the time of this panel and myself. So if we're going to be held to the same standard, which was questioned by the appellant as far as leasing information, I think the appellant should be held to the same as well. Thank you.
Okay, thank you, Mr. Neufeld. Do you have a brief summary, or Mr. Mercury?
Just before we go to that, just to clarify for Mr. Neufeld, we jumped into the summary. There was, I believe, an additional rebuttal document that Mr. Neufeld had. Mr. Neufeld, do you have that document? You're on mute there.
Yes, I do. This is the building classification document.
Okay, so does the board have that?
No, we do not.
I didn't get it either.
Mr. Neufeld, did you send an email right now?
I will resend it right now. I'm just.
No, I got an email. It contains a picture actually.
That was actually in regard to the article that I had provided, showing that the date of this conversion of 433 Main was June of 2020. And I was just thought the board would want to see it prior to their debate. This was another piece of rebuttal information that I had, and this is in direct response to Mr. Pohl's statement about classification. So I was not aware he would make that statement. So he has made it. So I believe I get to challenge it on rebuttal. And I've just reset that document. It's called Ken Croach.
No,
Office classification by Ken Croach.
You mind sending it again, please?
I did. Okay. Oh, I sorry, I should copy the assessor on that as well, unless I don't know if he's got a way of reading it where he is.
No. Madam Chair, can I ask Mr. Neufeld a question?
Sorry, you cut out. Sorry, can you?
Madam Chair, can I ask Mr. Neufeld a question
Regarding
this piece of evidence that he wants to submit?
Yes,
This is
sure.
about-
Sure.
So, Mr. Neufeld, you're contesting with this Class B building? Is that what you're doing now? And you have some
Yes.
information?
No, I'm contesting Mr. Pohl's statement where he said that OFB equals Class B. and his statement saying that the Johnson report was the same as the city's workup.
Just 1 second, Madam Chair. I'm gonna put that into the share folder.
And Mr. Paul is not on the computer, so I'll probably have to print him a copy.
Yeah, I have to print that for Mr. Paul. Okay, it's in the share folder, Madam Chair.
Sorry,
It's in the share folder, the document Mr. Newfeld just sent.
I don't have it yet in the shared folder.
It might come in a second.
Yeah. I still have not received it. Sorry, Mr. Hutchings, have you received it?
I have not.
It's not showing at the very top. File name is. Should be at the very top above the introduction.
No, I've checked the whole thing. I'm going to refresh it and see if it comes up.
Yeah, I refreshed, it's still not there.
It's not there for you to.
No.
It's there. Yes. Oh, yeah. It's the third document.
Oh, third document, oh.
1.3 carries. Pre-country button. Slow.
Okay.
Just the
Oh, that's in, no.
125 carry.
Mhm. Until they get, oh, okay.
Yeah, this one.
Oh, I see, okay. Okay,
I'll print for you, Mr. Wolf.
Thank you.
so I've got it was not on the top or the bottom, it was, says applicant's rebuttal.
And under 125, Gary, I still only have the two items, the assessor's information, the applicant's original, so. Let me refresh again.
I do have it now.
Okay, I just got it. Okay. Okay, does everybody have a copy of it?
Yes.
Yes, Madam Chair, everybody has it.
Is someone going to speak to it?
Yeah, does the assessor have a copy? Okay, just so perhaps Mr. Newfield could explain to us where he received this document, the context in which he received it, and take us through it. You're on mute.
I was actually aware of this document when it was first published. Mr. Croach told me about it, and at the time I thought nothing of it. When our hearing came up for 125 Gary. I recalled this document because there was the claims of building classification, and we asked for the assessor to provide it, because I couldn't find it, and they refused to cooperate. So we got a subpoena, and we served it on the city, and they never provided it. A few weeks after the hearing, Mr. Johnson, who took over the report from Mr. Croach, found a copy of it and sent it to me. And what it is the Johnson Croach report. This is their classification system for buildings, the original. So this is how they placed them in. And when we talk about classification, we are not talking about the same thing. They do a rating system of a variance in the Bs. And as you can see, 125 Gary's at the bottom of the Bs. It was when he wrote this in 2004, and even more so today. And I'm not sure if Mr. Mercury has any follow-up questions or clarifications to ask on it. That's the context.
No, and then obviously there are various Bs that are there, and you just summarize your view of this rating system in terms of how it applies to this appeal, and when we say that a building is a B, what does this report tell us?
Well, on page 2, or sorry, looking at this paging, it's marked at the bottom, page 3.
Okay, on the second page, we got it.
The second, yeah. There's a rating system as location, and it's all spelled out here, and you get a point for everything, and the qualities, and then the bonus features. And this is standard appraisal classification. It's just what do people want to see. Now, the only difference over time that has occurred is that it gave points for, the next page, of course, shows where you fall in the point scale. 25 plus is A, B 20 to 24, C 15 to 19, and then the floor area. Now, the only change that's occurred is the connection to pedestrian walkway, because when this was written, there were some changes in the walkway. So moving to the final page, and this shows everything in his B classification at the time, and you can see that it starts with about 6 down at 325 Broadway, and then goes down to 444 St. Mary, and then below that there's BS, which is B Suburban. And now in there, he further segregates them by rankings. So the subject property at 125 Gary is about a third of the way down, and then it ranks at the low end of the scale. So that's what makes it a B minus. Now, these buildings do not correlate to the city's OFB at all. This is a different rating system.
Mr. Neufeld, we lost you for a minute. Okay, you're back.
Okay, this rating system is not OFB, OFA, OFS. This is what the market uses, and we rate them on this basis. So if we're looking for a good B rent, we would be looking at 363 Broadway, or I'm just trying to look. I think the other one was rating one here was 59 Osborne, and that's the new part for Great West Life, not the old part. And I think, and the other highly rated Bs, I think 240 Graham is on the list, and Manulife with 386 Broadway, and the Revenue Canada building at 325 Broadway. So then the assessor asked kept going on about Hargrave, saying, well, Hargrave's a B, isn't it? No, Hargrave didn't even crack the C's here as far as I could see. Oh yeah, sorry, there it is. 6th from the bottom, 175 Hargrave, it's a C. And its rank on that is 16.
Yes.
So I guess the point is,
so we're addressing the Gary property.
Yeah, I know. But it was a statement the assessor made
no.
going on and on, and so we do not agree with their rating system. This was derived by Mr. Croach to assist practitioners in the industry, and not for assessment breakdown. So we do differ. And I don't know if there are any other questions.
I think those are the questions that I had. Unless the board has any questions arising from that, I think that's your submission, Mr. Neufeld.
Just one moment, please. No, Mr. Assessor, do you have any questions about this rebuttal evidence? Sorry.
Yes, I do. This is March 1st, 2000, correct?
Yes, that's correct.
Are you telling me that we're supposed to be adhering to a document prepared for the city of Winnipeg from Kenneth Croce from 2 decades ago and not current BOMA information?
Well, you know, the concept of appraisal began in 1763 with the man of Johann van Thunen, and so codified it in the 20s by Douglas Hurd. Things haven't changed. This is physical issues that relate to how you would classify a building in its marketplace. And I did mention there was one change, and that's to the pedestrian crosswalk.
Let me rephrase this. Does Colliers themselves use current BOMA standards, or do they reference this report?
Collier's brokerage utilizes their own system because they're the industry leaders. They've established their own system of ratings.
So basically, you want us to show deference to something that I've never seen. Probably no one has ever seen in an apartment since it was issued, and use this versus what the marketplace uses, which is BOMA.
No, that's incorrect. The marketplace doesn't necessarily use BOMA. Firstly, secondly, it is you do have it in your hands to look at and to review, and you have had it in your hands for 22 years. Thirdly, it sounds to me like you're talking about the city's model, which we've never seen, not what the industry uses.
That's all the questions I have.
Thank you very much. Mr. Diamond, any questions?
I don't have any questions.
Thank you. Mr. Hutchings, any questions?
Yes, quickly. So just to summarize, this document is a report prepared by Mr. Croce for the City of Winnipeg Assessment Department. Is that right?
When I asked him that question in 2004, that's what he said. It was prepared for the City Assessment Department.
Okay. But it was done in 2000, I believe. It was mailed to you or somebody in 2005, but it was prepared March 1st, 2000.
That was, yes, that's the date that he had on there. That's correct.
Okay, so you're asked, or no, maybe I'll put it this way. Do you have any proof that this is the methodology that the City of Winnipeg Assessment Department uses in this assessment cycle?
That wasn't why I was bringing it up. I was bringing it up to show that the assessor said that his methodology was the same as the Johnson Croce report. It is not. This is what started the Johnson and Croce report. Now, over the years, there have been some modifications. Wayne Johnson today actually relies more on Collier standards than he does on anything else. But that's not your question.
Thanks, Mr. Neufeld. That's all my questions.
Thank you. And I don't have any questions. I believe, excuse me, Mr. Paul, you provided your summary. So, Mr. Neufeld, Mr. Mercury, do you have a summary, a brief summary?
That's a challenge. I think there's something very simple before you. We have a building that in 2018 reported a vacancy of 57,000 square feet. Well, close to 50% of their property was available. By December of 2020, that had grown to 63,000 square feet of vacancy, over 50% of the building. As of the reference date, it had not been backfilled, and it won't get backfilled. The building is a victim of the change in market patterns, and there's nothing on the horizon that's going to change any of it, nor anything that would have been known on April 1st, 2021. As a matter of fact, April 1st, 2021, matters were even more bleaker because we were still dealing with COVID and we were still dealing with the shutdowns in office, where people were going to cancel their leases if they could or get out of them when they could and work from home. That was a trend that started before COVID, and COVID just hit that home, and that's the new norm. The information that you didn't want to look at was known in the marketplace, that conversion to other alternate uses of office buildings is what's going to happen. As of the reference date, there were at least 6 properties that were considering converting from office to multifamily. Some had done so already. And that's just the way of the office market. As leases expire, where the tenant had the ability to pay, the buildings will run to the end of the lease and then they won't come back. Where the tenant doesn't have the money and are judgment proof, they walk. And that's what's facing the market.
Sorry, I lost you there.
What's facing the market is just the continued loss of the space, whether it be at end of term or in middle of term. And this building is one of the most vulnerable to it because it's outside the major corridors. It's not near the arena or Portage and Main. And it makes a big difference. You saw the mark in that rebuttal about the connection to the pedestrian walkway, and that is a key factor now on what people want is to have that connection to the walkway. It's a massive selling point. It was in 2000, and was in 2021, and it will be in the future. So that's what we're dealing with here. We have an actual vacancy. Now, we haven't used 50% vacancy. We've applied it in a stabilized manner that considers that it might get better, and we've applied it at 27%, and that's a reasonable way of trying to stabilize the vacancy. And we're not looking for 51%, 57%. We're looking for 27%, and that's reasonable. There's no indication it's getting better. Aside from that, the other differences, we see a lower shortfall rate from the city. So I think the board should be bearing that in mind. We're not trying to present you a cherry-picked report where we like some parts, we don't like other parts. We're looking at it for what it is, and that's not ignoring the law. The law says the market value is determined by the most reasonable price that a willing seller will sell the property to a willing buyer. That's the definition in the Municipal Assessment Act, not this nonsense about fee simple. That's just something to hide behind to make a phony report. It does not exist. It's market value. So the property in Gary is going to sell differently than the one on St. Mary and the one on Portage. Just a fact. That's the market value of this building. So because we've dealt with a lot of the issues, first of all, no note was made of the fact that we agreed with what the potential rent is. The problem is it's never going to hit that potential rent because it's got this massive vacancy problem. And the other factor we looked at was the capitalization rate. Now, in 2018, because it hadn't been vacated yet, the appropriate appraisal approach would be to give it a high cap for an impending vacancy. When it happened in 18, you switch over and you then say, I'm going to apply a higher vacancy, and I can have a normalized cap. And 7.5 is the normalized cap for B- buildings. Thank you. That's my comments, and I don't know if Mr. Mercury has any.
Thank you. Mr. Mercury?
No further comments.
Okay, thank you very much. We've concluded this matter. I guess the next matter was it 240 Kennedy that we were going, there was an issue of non-cooperation?
Yeah, can I address that now?
Well, are you in fact leaving at 4 o'clock?
Yeah.
So if we begin this matter, are you going to be able to either finish it, both of you, in the next half hour, or stay till it's completed?
I'll have to continue. Mr. Neufeld sent indication that both they were not aware that it was owner occupied. They did not fill out that on their.
Wait, that wasn't the question. The question was about timing.
Non-compliant being withdrawn if I'm allowed to explain it.
It was a simple question. We have a half hour before you have to leave. So are you going to be, is this matter going to be finished if we start it now in the next half hour or not?
Non-compliance is being taken off the table. That's what I'm trying to explain. That will take up a lot of the time that would have had been.
You cut out. I didn't, are you, I can't hear you guys.
Mr. Paul said that he's not going to proceed with the non-compliance issue. He's prepared to remove it so we can go on.
Right, no. But the next issue, the next matter, are you guys going to be able to finish the whole matter in the half hour? Because the previous one took 2.5 hours. That's what I'm saying.
I can get through my presentation on value and any questions probably in 15. What I'm trying to point out is that non-compliance is being taken off the agenda.
I know, and I'm not discussing the non-compliance specifically. I'm discussing. Does anybody understand what I'm trying to say?
I think.
Can we finish?
I do.
Can we finish the appeal on 240 Kennedy within half an hour in totality?
Thank you.
My opinion is no. After what we've seen today, we have two very interesting dynamics at work here, and they don't fit together. So you're going to see more of the same.
We do have some issues with late evidence. 240 Kennedy revised brief is late. It is different. It shouldn't be allowed in. The original 240 brief should be allowed in as it was submitted on time. So the board decision from 180 King Street, 223 James, as it is a higher court order or higher board order, it is allowed in at any point in time. I have no objections to that. And the income statement from 2014, which was also received late as far as evidence, should not be allowed in. So.
Okay, so again, my original question is, can we deal with the next matter in a half hour before you have to leave because you've advised you're leaving at 4? I'm sensing, because no one will actually say yes or no, that the answer is no.
My presentation will take 15 minutes or so of the 30 minutes. I can get through it in 15 minutes. I can't.
Okay. Mr. Neufeld doesn't think he'll be able to get through his part, which is fair. So I guess we are concluding the hearing at this time. Unless one of the other board members has another suggestion.
No, if we start it, then the same panel is going to have to come forward to finish it. It's going to be very difficult to get us all together again and find a spot. So if we can't finish it, we shouldn't start it today.
I agree.
Okay. So we have heard one of the items scheduled at this hearing today, and the remaining items on the docket will have to be adjourned. And this hearing is now concluded.
Thank you, Melissa.
Thank you.